On this Wealth Wednesday, we are continuing our discussion on financial considerations for retiring. Today, we're talking income sources with Yvonne Delry, the investment specialist from FirstOntario Credit Union and Aviso Wealth. So why is it so important to start thinking about this long before you ever retire?
Yes. So it's very important for retirees to understand where their income sources are going to come from and then what their payments will be after taxes. So retiring is transitioning from the workforce and paying for your expenses with employment income to pension income. In Canada, we're fortunate. We've got a couple different levels that we can get income sources from in retirement. Some of them are federal and provincial, so Canada Pension Plan, CPP, OAS, and then there's also work pensions, so the defined contribution, which is the monthly payment based on time in the workforce and income sources. The other one is the defined contribution, where funds have been pooled together from employer contributions and employee contributions, which is then turned into an income stream, and then personal savings through RSPs and tax-free savings.
Okay, so let's start off with CPP.
Yes. So Canada Pension Plan, it varies for every individual because it is based on what the employer and the employee have contributed past the age of 18 and if your income was more than $3,500. So Canada Pension Plan, retirement age right now is 65. So you receive an unreduced value if you apply for the payments at age 65. If you want to start receiving them early, there is a reduced amount of 0.6% per month, up to 36% reduced if you take it at age 60. Or you can say, I'm going to delay taking Canada Pension Plan. It increases by 0.7% every month that you delay taking it, up to a maximum of 42% at age 70. So when you take it, depends on income needs, like do you need it? Do you have other sources of income that you could maybe take beforehand and allow CPP to continue growing until age 70, because that's kind of the latest for taking it.
Okay, all depends on your situation then, your health, what you want to do with the money, all that kind of things.
Absolutely. Okay. And life expectancy as well.
Yes, yeah. What about old age security then? Everybody gets that.
If you lived in Canada for 10 years past the age of 18, you will receive OAS. Or if you lived and worked in a country that had a social security agreement with Canada. You will get the full amount, though, if you lived in Canada for 40 years past the age of 18. There is, for some people, there's also the consideration of the pension recovery tax, also better known as the clawback, which is if you earn more than a predetermined amount, there is a 15% clawback for every dollar earned above that predetermined amount.
Okay, we've got less than a minute left, 30 seconds actually. There's some tax planning strategies too if both spouses are retired. Yes,
so the goal is to increase after-tax money. So there is income splitting that retirees can do with spouses. So the greater earning spouse can income split to the lower earning up to 50%, and then there is CPP sharing. So spouses can share their CPP.
Okay, so much to consider too.
Very much, and early, so the dream plan achieve. Early consideration, early planning.
Okay, especially in the market volatility right now. Thanks very much, Yvonne. We'll get all of the links up on our website at chch.com/morninglive.